Welcome back to the Deep Dive. It is Tuesday, January 27th, 2026. And if you have been glued to your screens this morning watching the pre-market and the opening bell, you know that we are not just dealing with another busy news cycle.
Not at all.
We are living through a moment that feels distinct, almost heavy with historical significance. It feels like the tectonic plates of the global financial system are shifting right beneath our feet.
That is exactly right. It's one of those mornings where the price action tells you a story that the headlines haven't quite caught up to yet. It really feels like the ground rules, the basic assumptions we all use to model risk, are being rewritten in real time.
We have two massive and, on the surface, completely contradictory forces colliding in the market right now. It's like watching two weather systems merge into a supercell. On one side, we have what everybody is calling the debasement trade. This is a historic, almost panicked flight from sovereign currencies and government bonds that has pushed the spot price of gold over that psychological $5,000 mark.
Which is a number that, let's be honest, if you had pitched that in a strategy meeting 12 months ago, you would have been laughed out of the room.
Laughed out of the room, exactly.
$5,000 gold was the stuff of doomsday prepping, It wasn't part of any institutional base case, but here we are.
Exactly. And then if you swing the camera to the completely opposite side of the spectrum, we have the AI CapEx supercycle. We are looking at big tech preparing to spend, some bears might say incinerate, over $500 billion this year alone on AI infrastructure.
Yeah.
And this is happening even as we get reports that half the CEOs in the world are saying they haven't seen a dime of profit from it yet.
It creates this fascinating high-tension paradox. You have macro capital fleeing the system, running away from fiat and bonds because of these debasement fears.
Yeah.
And simultaneously, you have corporate capital just flooding into the system, specifically into hardware, GPUs, and data centers, chasing, the ghosts in the machine.
So here is our mission for today. We aren't doing a general news recap. We are speaking directly to the Theta Fuse audience here. You guys are active options traders. You care about edge. You care about implied volatility, skew, and flow.
That's right.
You want to know where the capital's going so you can position yourself ahead of the move? We need to unpack these numbers, not just what they are, but what they mean for risk premiums and for the trade setups for the rest of Q1.
We are going to strip away the noise and look at the mechanics, because when you see positioning this one-sided in the dollar or divergence this extreme in tech earnings, that is where the opportunity lives. But as any veteran trader knows, crowded trades are also where the trapdoors are.
Let's start with the big flashing number on the screen, Section 1, the debasement trade. We have to do a technical breakdown of gold and the dollar here. The headline number is gold spot price holding above $5,000 an ounce.
$5,000. It really is a milestone. It's the kind of level that forces asset allocators to rewrite their models from the ground up.
It's not just the price, though. It's the momentum. The rally has extended for 7 straight days now. We saw it gain another 1.8% on Tuesday alone. And now we have Deutsche Bank coming out with a note essentially chasing the price.
Been chasing it.
Raising their forecast to $6,000 an ounce by year end.
And we have to be very careful here not to fall into the retail trap of just thinking gold is going up. The sophisticated view, the Theta Fuse view, is the dollar is going down.
Yes.
Or even more accurately, confidence in sovereign assets is evaporating. This isn't about people falling in love with shiny rocks. This is about people terrified of the alternative.
Let's unpack that why, because this is the part that confuses the textbook economists. Usually when you see interest rates where they are, relatively high compared to the last decade, gold struggles.
It should struggle.
Gold has no yield. It costs money to store. Why would you hold gold when you can get a decent yield on a bond? But that correlation has just completely broken down. What is driving this flight?
It's the debasement trade in its purest form. Investors are retreating from currencies and treasuries because they fear the issuer is, insolvent or politically unstable. And there is a specific catalyst mentioned in the data that we really need to highlight: the Japanese bond market.
Right, the JGBs, the Japanese government bonds.
Exactly. There's a massive sell-off happening in the Japanese bond market right now. Japan has been the anchor of low rates for decades.
The anchor, for sure.
When that anchor drags, it triggers a contagion effect. It forces a global rethink of sovereign risk. Investors look at Japan, they look at the US, they look at the debt loads, and they say, I don't want to be the one holding the bag when the music stops.
We have a quote here from Amundi Shinsei. For our listeners who don't follow the European scene closely, Amundi is Europe's largest money manager. They manage trillions. This isn't some fringe newsletter.
Right. This is smart money. This is the establishment speaking.
They are explicitly saying that America's growing isolationism is prompting investors to cut dollar assets and shift into gold and real assets.
That is a critical shift in institutional behavior. When the largest money manager in Europe says they are cutting dollar assets, not because of yield differentials, which is the normal Forex driver,
Right, the normal playbook.
but because of isolationism and debasement, that is a structural shift. Vincent Mortier, their CIO, put it very bluntly. Gold in the long term is a very good protection against debasement. It's not a trade anymore, it's a strategic allocation.
So let's bring this back to the Theta Fuse crowd. We are options traders. We look at the Greeks. What is the options market telling us about this dollar move? Because the spot price is one thing, but the derivatives market is where the truth usually hides.
This is where it gets really interesting, and honestly, if you are short volatility, it should make you sweat. Dollar traders are currently paying the highest premium on record, and this data goes back to 2011 for short-dated options betting on a deeper dollar sell-off.
The highest on record.
The highest on record. The skew is incredibly steep to the downside. Everyone is paying up for puts on the dollar. The market is effectively shouting that they expect the floor to fall out.
And there is another indicator, flashing red in the notes. The butterfly. Can you break that down for us?
Yes. For those who might not trade these structures often, let's explain that. A butterfly spread is a combination of options. In this context, when we talk about demand for butterflies, we are talking about demand for protection against outsized price swings.
So you're not just betting on direction.
Not at all. You are betting on the fat tails of the distribution curve. You're saying, I think something crazy is about to happen.
So you aren't betting on a small move. You are betting on a crash or a moonshot.
Exactly. And demand for butterflies has hit a 7-month high. This tells us that the market isn't just betting the dollar goes down, they are betting it might move violently. They are bracing for a breakout from recent ranges, and they expect it to be explosive.
We are seeing this in the risk reversals too, right? For the euro and the Aussie dollar.
We are. It's across the board. If you look at the euro and the Australian dollar, since Thursday, 2/3 of all options trades are bets on further greenback weakness.
2/3. That is incredibly crowded positioning. I mean, that's just begging for a squeeze, isn't it?
It is heavily one-sided, to use the technical term, and as a trader, that should make your ears perk up. When everyone is on one side of the boat, volatility tends to spike. And indeed, 1-week dollar volatility has spiked to its highest level since September.
Okay, so we have the positioning, it's extreme. But what is the fundamental fuel? We mentioned isolationism, but let's get specific. The political risk premium seems to be back with a vengeance.
It is. The market hates unpredictability, and right now, U.S. politics is the definition of unpredictable. We have reports citing the Trump administration's recent actions as a direct volatility driver.
And these aren't just tweets. These are significant geopolitical moves. The source material mentions threats to annex Greenland,
Which introduces significant diplomatic uncertainty with Europe, specifically with Denmark, and it just throws a wrench in everything.
military intervention in Venezuela.
Geopolitical risk premium. Right there. You're talking about supply chains, oil prices, regional stability. The market has to price all that in.
And renewed attacks on the Federal Reserve's independence. This feels like the big one.
That is the big one for the currency markets, absolutely. If you threaten the independence of the central bank, you are directly attacking the credibility of the currency. A Danske Bank analyst summed it up perfectly in the notes. Unpredictable U.S. politics is unambiguously dollar negative.
Unambiguously dollar negative. That is a strong conviction. You don't often hear an analyst use a word like unambiguously.
You really don't. It's a statement. When the executive branch starts fighting the central bank, capital runs for the exits. That exit, right now, is gold.
So we have the dollar under siege, gold skyrocketing as the anti-dollar, and volatility premiums blowing out. If you were sitting on a cash pile, you are nervous. But if you were trading gamma, this is paradise.
It is paradise, but it's a dangerous paradise. Because with positioning this, stretched record premiums for dollar puts, any single piece of news that stabilizes the dollar could trigger a violent short squeeze. But for now, the trend is your friend, and the trend is debasement.
Speaking of the trend, let's zoom out a bit. While the U.S. is seemingly turning inward tariffs, threats, isolation, the rest of the world isn't just sitting around waiting.
Not at all.
They are linking up. This brings us to Section 2, the geopolitics and sector rotation. Specifically, this mother of all deals between the EU and India.
This is a massive story that I think is getting buried a bit by the gold headlines, but for sector traders, this is where the alpha is. This is actionable. This is where you can find an edge.
So after 20 years of negotiations, 2 decades, the EU and India have finally signed a free trade agreement. Ursula von der Leyen calls it the mother of all deals.
And looking at the specs, she might not be exaggerating. You are creating a free trade zone of 2 billion people. That's a quarter of the world's population. The expectation is that EU exports to India will double by 2032.
But the timing here is what makes it so spicy. This is explicitly framed as a rebuff to Trump's policies.
It is a defensive maneuver. It has to be. India is facing a potential 50% tariff from the Trump administration on their goods. They need a new market. They need a lifeline.
And Europe.
And Europe needs to diversify away from its reliance on the U.S. and China. So you have this convergence of interests born out of necessity. It's a reaction to U.S. policy.
It's the anyone but America trade.
In a way, yes. It's a strategic pivot. And what's really crucial here is that India is shedding its reputation for protectionism, which has been a huge hurdle for decades to lock in this deal.
How much are they cutting?
They are cutting tariffs on 96.6% of shipments. That is unprecedented for New Delhi.
For 96.6%. That is basically swinging the doors wide open.
Mm-hmm.
So let's get into the weeds for the traders. Who wins here? Because free trade is a broad concept, but we need specific tickers, or at least specific sectors.
Yeah.
The auto industry stands out immediately.
Huge win for European autos. Under this deal, New Delhi is allowing 250,000 European-made vehicles to enter India at preferential duty rates.
250,000 vehicles.
Yeah.
Is that a lot in the grand scheme? How do we contextualize that number?
It is massive. To give you context, that quota is more than 6 times larger than other recent deals India has signed. If you are a German car manufacturer, Volkswagen, BMW, Mercedes, you just got preferential access to one of the fastest growing middle classes in the world.
And it comes right at the moment when the U.S. market is becoming hostile with tariffs.
Exactly. It's a perfect hedge. That is a clear, long signal for European autos. If you are trading the DAX or looking at ADRs for those manufacturers, this is a major tailwind. It directly offsets the U.S. risk.
But trade deals are a two-way street. What is India getting out of this? What's their big win?
India plays to its strengths. The deal gives them a competitive edge in labor-intensive goods. We're talking apparel, gems, jewelry, and footwear.
Stuff that usually gets hit hard by tariffs.
Exactly. These sectors were absolutely hammered by the Trump tariffs. If you are an Indian textile exporter, your U.S. order book just evaporated overnight. But this deal with the EU replaces that lost demand. It provides a lifeline.
So if we are looking at sector rotation, you want to be long European industrials and autos, and you want to be looking at Indian emerging market ETFs that focus on manufacturing and textiles.
Correct. And structurally, it signals that India is serious about becoming the alternative to China. They are pivoting. They're saying, we are open for business. And for a trader, seeing a country like India cut tariffs on 96% of goods suggests a structural reform story that could drive growth for the next decade.
It really highlights the divergence, doesn't it? The U.S. is putting up walls, the rest of the world is building bridges, and capital tends to flow where it can move freely.
Which brings us right back to that debasement trade. If the U.S. is isolating itself, the dollar loses its utility as the global lubricant of commerce. The euro and the rupee just get a little more useful.
Fascinating stuff. Now, let's pivot from the macro politics to the corporate battlefield. Because while governments are arguing over tariffs, big tech is arguing over who can spend the most money the fastest. Section 3, the $500 billion AI gamble.
The numbers here are they are staggering, even for tech, which is used to big numbers.
We are kicking off earnings season. We have Microsoft, Meta, and Amazon all lined up, and the headline expectation is that they are going to lift AI spending by 30% this year, pushing the total to over $500 billion.
$500 billion.
Yeah.
$500 billion in 1 year. That is the GDP of a mid-sized country, purely on chips and data centers.
It is an unprecedented outlay. And the market is starting to get a little twitchy about it. We are seeing the real divergence in stock performance. Let's look at the last 3 months of 2025.
This is the show me the money phase. The honeymoon is over. Investors want to see returns.
Exactly. Microsoft and Meta both down more than 6% in Q4 of 2025. Why?
Yeah.
Because of the wall of worry.
It is the doubt. Specifically with Microsoft, they had the first mover advantage with OpenAI. They were the kings. Everyone thought they had an insurmountable lead.
They did.
But now investors are asking, did you squander it? Is OpenAI still the leader? The decline suggests the market isn't sure anymore. The implied volatility on MSFT earnings is pricing in a lot of anxiety.
And then you have Amazon, up about 5.1%. Not a rocket ship, but steady.
Amazon played catch-up well. Their November deal with OpenAI signaled they weren't a laggard anymore. They stabilized the narrative. Plus, they are the picks and shovels play with AWS. They win no matter who builds the best model to some extent.
But the real story, the alpha leader, is Alphabet. Google surged 29% in that same period.
This is the most interesting reversal in the tech space. For a long time, Google was seen as behind or confused. ChatGPT killed search, remember that?
I remember it well. That was the narrative for months.
But the launch of the Gemini 3 model changed the game.
Gemini 3 was received well.
Very well. It proved they could compete on the foundation model level. It was a technical powerhouse. And crucially, they struck that deal to power Apple's revamped Siri.
That feels like the checkmate move.
Yeah.
Getting into the Apple ecosystem.
It is a massive moat. As David Wagner from Aptus Capital put it in our notes, Alphabet has the upper hand. Proprietary ecosystems are tough to penetrate. By locking in the Apple ecosystem, Google secured distribution. And in AI, having the best model is nice, but having the best distribution is everything.
So Google is winning the stock chart right now. But I want to get into the tail of the tape on the cloud revenue numbers. We have LSEG data here, and for our listeners, this is the nitty-gritty you need to watch. This is where the algos trade.
Let's break it down. This is absolutely critical for earnings.
Google Cloud. Revenue growth likely quickened to 35%, up from 33.5%.
Acceleration. That is the key word.
Yeah.
When you are growing at that scale and you accelerate, that commands a premium multiple. It says demand is outpacing supply. It's the holy grail for a growth investor.
Now compare that to Microsoft Azure, expected to post a 38.8% rise. Now, pause for a second. 38.8% is a bigger number than 35%. So why is the stock lagging?
Because it is slower than the previous quarter. They were at 40%. Now they're at 38.8%. That is deceleration.
Oh.
In the options market and in growth equity, we trade the second derivative, the rate of change. Google's rate of change is positive. Microsoft's is negative. That explains the stock divergence almost perfectly. The market hates deceleration more than it loves absolute growth.
And then AWS. Where does Amazon fit in?
Amazon Web Services likely grew 21.1%, up from 20.2%. Slow and steady acceleration. Not exciting, but stable. It confirms that the overall market for cloud is still growing, but Google is the one capturing the momentum right now.
So the trade here has been long Google, short Microsoft, or at least underweight Microsoft. But let's play devil's advocate. We are spending $500 billion. Is this a bubble?
That is the $500 billion question, and the source material gives us plenty of reasons to be worried. There was a PwC survey of 4,454 CEOs.
A huge sample size. This isn't just a handful of tech bros in Silicon Valley.
Huge. This is global, cross-industry, and more than half of them said they realized neither revenue nor cost benefits from their AI investments yet.
Zero. Not even a little.
Neither revenue nor cost benefits. They are spending the money, but they aren't seeing the ROI. They are buying the tickets, but they aren't enjoying the show.
That is terrifying. If you're a shareholder of one of these cloud companies, that has to worry you.
It is. Satya Nadella, the Microsoft CEO, even admitted it at Davos. He said, and I'm quoting here, "For this not to be a bubble, it requires that the benefits are much more evenly spread."
Translation. Please, for the love of God, start making money using our tools so we can justify this CapEx.
Exactly. The risk here is that investors lose patience. They are demanding payoffs from this expensive push into superintelligence. As the article notes, first mover advantage doesn't always win the marathon.
That's a great point. We can all think of examples.
Think back to the dot-com era. Being first doesn't guarantee you survive if you burn all your cash before the revenue shows up. Look at Yahoo versus Google.
So we have a situation where the hyperscalers, Google, Microsoft, Amazon, are forced to spend this money to stay in the game. It's an arms race they can't afford to lose. But the customers, the CEOs in that PwC survey, aren't seeing the value yet.
That is the disconnect, and that disconnect is where the volatility comes from. If one of these earnings calls reveals that CapEx is going up, but cloud growth is slowing further, look out below. That is the setup for a massive correction.
So Section 4, the convergence. How do we connect these dots? We have the debasement trade on one side and the AI gamble on the other. What is the synthesis here that feel like two different worlds?
They feel that way, but I think they are two sides of the same coin. The theme is capital allocation under stress.
Unpack that. What do you mean by under stress?
Think about the behavior of capital right now. On one side, you have macro capital pension funds, sovereigns, central banks. They are stressed by fiscal irresponsibility and political unpredictability.
Okay.
They are fleeing fiat. They are buying gold. They are buying real assets. They are looking for safety from debasement.
Right. They are running away from the dollar. It's a flight to safety.
On the other side, you have corporate capital. They are stressed by the fear of obsolescence. They were terrified that if they don't spend this $500 billion on AI, they will die. They'll be the next blockbuster. So they are deploying massive amounts of cash into hardware and infrastructure.
So everyone is running away from cash.
Exactly. That is the connection. Nobody wants to hold cash. The macro guys buy gold because they think the cash will be worthless. The corporate guys buy GPUs because they think holding cash is an innovation death sentence.
Wow, that is a brilliant way to frame it. It's a flight from cash in all directions.
And for the trader, the takeaway is simple. Volatility is the asset class. Forget stocks, forget bonds. The thing you want to own is volatility itself.
We are seeing it in the data. 1 week, dollar volatility spiking to highs since September. We're seeing COMEX gold volatility at March 2020 levels.
March 2020. Think about that for a second. That was the height of the pandemic panic. The world was shutting down. We are seeing those levels of implied volatility in gold now during a bull market.
That's insane.
That tells you this isn't a calm, steady climb. This is a violent repricing of global risk.
And in tech, the decoupling Google up 29%, Microsoft down 6%, means you can't just buy the QQQ and go to sleep anymore.
No. The correlation is breaking. The days of the Magnificent Seven all moving in lockstep are over, at least for now. You have to be stock specific. You have to look at the relative value trades. Long Google, short Microsoft has been a widowmaker trade for years, but suddenly it's the winning trade.
It really feels like a stock picker's market disguised as a macro market. You need to understand both.
It's both. You have to get the macro right, gold versus dollar, to understand the liquidity flows and the risk environment. But then you have to get the micro right, Google versus Microsoft, to capture the alpha within the equity bucket.
So let's summarize what we've covered today, because there is a lot here to digest. I think we could break it down into 3 key takeaways.
Let's do it.
Point 1, gold is the anti-dollar trade. It's above $5,000, and the options volume supports it. The market is betting on debasement and isolationism.
And volatility in that sector is historically high. Don't sell the tails. If you are selling calls on gold here, you have to be very, very careful. The gamma risk is huge.
Point 2, the EU-India deal is the anti-isolationist trade. While the U.S. builds walls, India and Europe are building a 2 billion person free trade zone. Autos and apparel are the direct beneficiaries.
Watch the German car makers and Indian textile exporters. That is a clear policy-driven trade, and it's probably under the radar for a lot of U.S.-focused investors.
Point 3, in the AI wars, Google is winning the current leg of the race. Gemini 3 plus the Apple deal has given them momentum. Meanwhile, the market is demanding proof of profit from Microsoft and Meta before they endorse another $500 billion in spending.
The bar has been raised. Spending money isn't enough anymore. You have to show the acceleration in revenue. Google is showing it. Microsoft is struggling to show it relative to those sky-high expectations.
Now, before we sign off, we promised a final provocative thought. Something to keep you up at night, maybe mull over before the next trading day.
We talked about how crowded the short dollar trade is. Record premiums for puts. 2/3 of trades betting on weakness.
Right. It feels like everyone is on the same side. The boat is listing.
Here is the scenario. What happens if the U.S. administration decides that a weak dollar is actually a national security threat? Or what if they intervene to support the yen, as hinted at in the source material, to stabilize the Japanese bond market? What if the Fed and the Treasury step in?
Intervention.
Yeah.
The one thing the market isn't pricing in.
Exactly. If we get a coordinated central bank intervention to prop up the dollar or the yen, all of those record-high premiums for dollar puts go to zero overnight.
And the short squeeze.
The short squeeze on the dollar would be catastrophic for the debasement trade. It would be violent. If the dollar rips higher by 3% in a day, gold could crash $500 in a day. We are sitting on a powder keg of one-sided positioning.
So the trade is working beautifully right now, but the exit door is very, very small.
Exactly. When everyone is on the same side of the ship, even a small wave can capsize it. And a central bank intervention isn't a small wave, it's a tidal wave.
That is the thought to leave you with. Keep your premiums high, keep your theta burning, and for the love of God, hedge your tails. This has been The Deep Dive. We'll see you next time.
Stay safe out there.